Welcome, today we will be reviewing your stock suggestions for April 2025, so let's get started. First on the list is TTWO, which is called Take-Two Interactive Software, and this company basically engages in the development and marketing of different interactive software games. And although you may probably not know this company, if I tell you that they are the producers of GTA, then you would probably become a lot more interested in this stock all of a sudden. However, as we can see, this company has been having negative net incomes for the past quarters, and this has caused for the return on capital employed to be a negative 34% and for the free cash flow yield to be a negative 1.3%. However, as we can see, the balance sheet for this company looks pretty good, with their assets being way above their total liabilities, and when we look at their historic valuation ratios, we cannot use price to earnings or price to cash flow since both of these metrics are negative, so we have to use the price to sales and price to book ratio. But when we look at this, we can see that although the company has been having pretty rough quarters, their valuation has still gone up in the latest quarters. And this is due to the fact that the date of launch for GTA 6 is getting closer and closer, and investors have high hopes for this game. This is responsible for their price to book ratio to have almost doubled in 7 quarters, which is very impressive considering that their fundamentals have not gone anywhere. Which means that I would have to give this company 2 stars out of 5 because of its unpredictability. Who knows what could happen to the game? Chances are it will be a very successful launch, but with expectations this high, anything could happen to the stock price. Stock number 2 is Airbnb, which as you all know is an online marketplace which connects both hosts and guests in order to book locations or rent out holiday rentals. This company has a very high return on capital employed of 31% and a very juicy 5.5% free cash flow yield. On the one hand, the return on capital employed is more than double the 15% threshold that we usually set for quality companies, and on the other hand, the 5.5% free cash flow yield may actually indicate that this company is trading at a low valuation. However, we can see that the fundamentals for this company are not very predictable either. It's very hard to judge their revenues, their gross profit, and their net income on a quarter-to-quarter basis. However, it is clear to see that 2024 was a worse year for this company than 2023. If we were to look at year-over-year growth, however, from Q4 2023 to Q4 2024, which is the latest one, the company went from negative net income to positive net income, which could be a positive development for the sector. When we look at their balance sheet, this company again has total assets which are above their total liabilities, and when we look at their historic valuations, I prefer to look at the price to cash flow ratio since it's a lot more stable, and this basically looks like it's trading right around average of where it has been trading for the past 2 years. If we combine this 20 times price to cash flow ratio with the 5.5% free cash flow yield, it means that Airbnb could actually be an interesting company to analyze further. I give this company 3 stars because it's highly cyclical, and I believe that in the tourism industry there are better alternatives. However, since it's trading at an attractive valuation, it might outperform the S&P. Company number 3 is Duolingo, and we've spoken about this company a lot on the channel. It basically engages in the development of language learning via their website and also has a text translation platform. This company has a 12% return on capital employed, which is improving at a pretty fast pace, and a 1.7% free cash flow yield. This is because, believe it or not, this company is a fast grower, which makes it reasonable for it to have a hefty valuation. As stated, we can see that the revenue growth is almost exponential and the gross profit is staying right beside it. Their net income had been increasing at a very fast pace all the way from early 2023 to late 2024, except for this latest quarter where their net margins actually collapsed. However, when we look at their balance sheet, again this is increasing exponentially since the company is growing, but their total assets are always staying on top of their total liabilities, which is key. And when we look at their historic valuation ratios, we can see that the metrics are a bit distorted because the first quarter where they had positive net income, this was so little that it actually made their price to earnings ratio blow out and be almost at 800 times. And now we can see that in the latest quarter, their price to earnings cash flow was still above and around 150 times, which is still a very hefty valuation, even though the company is growing at a very fast pace. This basically means that the market has high expectations, which could cause for any bump in the road to make this company's stock price collapse. This is why I give this company a 3-star, because although it's a high growth company, it has an uncertain margin evolution, and it's trading at a high multiple. Before we move on to stock number 4, remember that all these charts are made with TradingView, and you have a link down below in case you want to join any of the premium plans with a discount. But now next stock is BSX, Boston Scientific, and this is a medical devices company which develops products for interventional medical procedures. Now this is also a fast grower, and we can see that by their 1.8% free cash flow yield. The market is also demanding high multiples for this company, and now this company has an 8% return on capital employed, which is below our threshold. However, we can see that their growth and their margin evolution has been pretty predictable and pretty consistent, which is what we like to see, and their balance sheet again looks good since their total assets are more than double their total liabilities. But when we look at their historic valuation ratios, we can see that, of course, since it's a very high growth company and a high quality firm, their price to earnings ratio is currently at around 75 times, and their price to cash flow ratio, which is generally lower, is still sitting around 40 times. However, taking all of this into account, I still give this company 4 stars out of 5, because it's a growth company with expanding margins and a very nice balance sheet. The only problem that it has is that it's very difficult to buy this company on a dip, but if you're able to do so, I believe you will outperform the S&P 500. Next is ticker symbol SHOP, Shopify. I'm sure you all know this company because it's very big on YouTube, but it's basically a cloud-based commerce platform which is designed to help small and medium-sized businesses. You will probably have heard of Shopify and dropshipping in the same sentence together, but the fact is that Shopify is used by a lot of legit businesses. This company has a 19% return on capital employed and an 11% free cash flow yield. We can see that their total revenue peaked in the latest quarter, which is generally when all of the annual memberships for their website are executed, and they also came in with record net margins, which is great to see because when we compare to the year prior to this one, their margins were a lot lower. And you just have to give props to this company, they barely have any leverage. Their total assets are growing while their total liabilities are stagnant, and additionally, their total assets are way higher than their liabilities. However, again, since this is we can call it sexy business, it trades at a high valuation, with a price to earnings ratio of around 75 times and a price to cash flow ratio of around 70 times, which is why I have to give this company a 2-star because it has unpredictable revenue growth. As we can see in Q2 2023, their net margin suddenly collapsed and there was no explanation of that, and additionally this is trading at very high multiples. Following on, we have FICO, with the official name of the Fair Isaac Corporation. The official definition for the business that this company performs is that it provides analytic and decision management solutions and also financial scoring solutions. Whereas we all know that FICO is famous for the FICO score, which is their credit score which almost every single financial institution in the US uses. The perks of being a monopoly is that your financials look amazing, and you're able to have a 56% return on capital employed and maintain that over time. However, since this company is such high quality, this makes them have a very high valuation, with a 1.4% free cash flow yield. Their financials have been growing very quickly. However, this still shines light on that they're maintaining best-in-class margins and they're managing to grow their top line at a pretty fast pace. However, they do have a red flag, which is the fact that their total liabilities are above their total assets. Now, don't get me wrong, this may be nothing. However, having negative equity and not being able to pay all of your liabilities with your total assets is usually something that I prefer to look into because I'm more of a conservative investor. And although FICO has been operating in this way for the past years, it doesn't hurt to double check and just make sense why this is happening. However, as we all know and we've commented before, they trade at very hefty valuations, with their price to earnings ratio sitting now just above 90 times and their price to cash flow ratio sitting above 70 times. So despite me believing that this is an amazing company, I have to give it 4 stars due to the negative equity and due to their high valuation. Next on the list we have Intel, which manufactures and sells computer products which are specifically semiconductors. This company was the king a couple of years back, but with the rise of alternative semiconductor and microchip producers, they have kind of been left in the dust. They have a negative 7% return on capital employed, a negative 15% free cash flow yield because they're investing a lot without actually having positive net income. And as we can see from their income statement, this does not look like a solid business. They have just changed management, they have changed the CEO in order to try and conduct a turnaround, but I believe it's in a very rough position. If we look at their balance sheet, at least they can cover their total liabilities with their total assets, which is a point going in Intel's favor. However, when we look at their historic ratios, I believe that these ratios are low, but because of a reason. So I will have to give this company a 1 star because it's unpredictable and it's a cash burning machine. And last but not least, we have Nike, which we all know develops and sells athletic footwear and other apparel, and this company has been going through it recently. They have a 21% return on capital employed, which is pretty decent, and they have a 5.6% free cash flow yield. So there are a lot of people suggesting that this may be undervalued due to their valuation ratios. However, you have to look at their fundamentals as well. Their revenue has been decreasing for consecutive quarters, their margins have been contracting, and there is no clear reversal signal. meaning that they still have a couple of quarters in order to try and stabilize their financials and get everything under control again. When we look at their balance sheet, at least they have total assets which are above their total liabilities, and this is solid. But if we look at their historic valuations, it seems like it has not been affected by these very negative developments. They're still trading at a 27 times price to earnings ratio, which I can understand if Nike was growing at a solid pace. However, if you have to pay 27 times the earnings of a company, which is again a turnaround play, I believe that this is just too much of a risk to take. So this is why Nike is a 2-star for me. And having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.